Most people know they should invest, but few actually understand where to start. Is it stocks, mutual funds, real estate, crypto? The truth is, investing isn't just about picking the right thing, it's about building a plan that works for you. So in this video, we're breaking down everything a beginner needs to know about investing, step by step. So by the end, you'll have a clear roadmap to start growing your wealth. Imagine you put $1,000 in a savings account and leave it there for 10 years. Because of inflation, the prices of things like groceries, gas, and rent keep rising. So your money quietly loses buying power every year. For example, $100 in the year 2000 is worth only about $55 today. That means your money can buy almost half as much as it could just a generation ago. Saving is important for emergencies, but if you only save, you're missing out on the chance to grow your wealth. Investing lets your money work for you instead of just sitting still. Think of it like planting seeds. If you just store seeds in a jar, nothing happens. But if you plant them and care for them, they grow into something much bigger over time. That's why wealthy people focus on building assets, like stocks, real estate, or businesses that increase in value and generate income. They don't just save, they invest so their money keeps working for them year after year. Before you invest a single dollar, take a moment to set clear goals. What do you want your money to achieve for you? Are you saving for retirement, a down payment on a house, your child's education, or maybe a dream vacation? Each goal has a different timeline and risk profile. Next, ask yourself, when will you need this money? Short-term goals like buying a car in 2 years require safer investments. Long-term goals like retirement in 30 years allow for more growth and risk. Now let's talk about risk tolerance. This means how much ups and downs you can handle, both financially and emotionally, without losing sleep or making rash decisions. For example, if you're 22 and saving for retirement, you can afford to take more risk since you have decades to recover from market swings. But if you're 55 and nearing retirement, you'll likely want safer income-focused investments. Remember, risk tolerance isn't just about numbers. It's about how you feel when markets drop. If you panic and sell, you might need a more conservative approach. Be honest with yourself. To sum up, define your goals, set your timeline, and know your risk tolerance. These steps will help you build an investment plan that fits your life, not someone else's. Let's start with stocks. When you buy a stock, you're buying a small piece of a company, like owning a tiny slice of Apple or Google. Stocks have historically offered high returns, but their prices can swing up and down a lot in the short term. The main advantage of stocks is their growth potential. Over the past century, the stock market has averaged about 7–10% annual returns after inflation. But stocks can also drop sharply during recessions, so they're best for people who can handle some risk and plan to invest for many years. Next, bonds. Think of bonds as IOUs. You lend money to a government or company, and they pay you interest over time. Bonds are generally less risky than stocks, but they also offer lower returns. Bonds are great for stability. They usually don't grow as fast as stocks, but they help protect your money during market downturns. They're ideal for people who want steady income or are closer to retirement. Index funds and ETFs are like baskets that hold dozens or even hundreds of stocks or bonds. Instead of betting on one company, you own a little bit of many, which spreads out your risk. These funds are popular with beginners because they're low-cost, diversified, and have a strong track record. For example, the S&P 500 Index Fund has returned about 10% per year on average over decades. Real estate means owning property, like a house, apartment, or commercial building. It's a tangible asset you can see and touch, and it can generate rental income. Real estate can be stable and provide steady income, but it usually requires more money up front and isn't as easy to buy or sell quickly. It's best for people who want long-term stability and can handle the responsibilities of ownership. Commodities include things like gold, silver, and oil. People invest in them to protect against inflation or economic uncertainty, since their value often moves differently than stocks. Commodities can be very volatile and don't always grow in value over time. They're best used as a small part of a diversified portfolio, not the main focus. Finally, crypto. Cryptocurrencies like Bitcoin and Ethereum are digital assets that use blockchain technology. They can offer huge gains, but prices can swing wildly, even in a single day. Crypto is highly speculative and not regulated like traditional investments. It's best for people who are comfortable with big risks and only want to invest money they can afford to lose. To sum up, most beginners do best with a mix of index funds or ETFs, some bonds for safety, and cash for emergencies. As you learn more, you can add other assets to fit your goals and risk tolerance. Compound interest is often called the eighth wonder of the world. But what does it really mean? Simply put, it's earning interest on both your original money and the interest that money has already earned. Let's compare simple interest and compound interest. With simple interest, you only earn on your original amount. With compound interest, you earn on your original amount plus all the interest that builds up over time. Here's the math. If you invest $1,000 at 8% interest compounded yearly, after 1 year, you have $1,080. The next year, you earn interest on $1,080, not just $1,000. Over time, this snowballs. Now let's see what happens if you invest $500 every month at that same 8% return. After 10 years, you'd have about $91,000. But if you keep going for 30 years, you'd have over $745,000. What if you start with a different amount or a different rate? For example, $200 a month at 6% for 30 years grows to about $200,000. The earlier and more consistently you invest, the more time your money has to grow. The key is to start as early as possible and keep adding to your investments, even if the amounts are small. Consistency and time are your best friends when it comes to building wealth. Remember, time in the market beats trying to time the market. Let your money work for you and watch compound interest do the heavy lifting. Step 1. Build your emergency fund. This means saving 3 to 6 months of living expenses in a safe, easily accessible account. Why? Because life happens. Unexpected bills, job loss, or emergencies can strike at any time. Having this cushion keeps you from dipping into investments or going into debt. How to do it? Set up a separate savings account and automate transfers each month. Even small amounts add up over time. Common mistake: keeping your emergency fund in the same account as your spending money. Keep it separate so you're not tempted to use it. Step 2. Pay off high-interest debt like credit cards. Why? Because the interest you pay on debt is usually much higher than what you'll earn investing. Focus on paying off anything with double-digit interest rates before you start investing. How to do it? List your debts, pay more than the minimum on the highest interest one, and avoid taking on new debt. Mistake to avoid: investing while still carrying expensive debt. It's like trying to fill a bucket with a hole in it. Step 3. Choose a brokerage or investment platform. This is where you'll actually buy and manage your investments. Look for low fees, good customer support, and easy-to-use apps or websites. Tip: read reviews, compare fees, and check if the platform offers the types of investments you want. Mistake to avoid: picking a platform just because of flashy ads. Do your homework. Step 4. Start with index funds or ETFs. These are bundles of stocks or bonds that track the market, making them simple and low cost for beginners. Why? They're diversified, so you're not putting all your eggs in one basket. How to do it? Search for broad market funds like the S&P 500 and invest a set amount each month. Mistake to avoid: chasing hot stocks or trying to time the market. Stick to your plan. Step 5. Automate your contributions. Set up automatic deposits from your paycheck or bank account into your investment account. This makes investing a habit, not a chore. Tip: even small, regular contributions grow over time thanks to compounding. Mistake to avoid: waiting for the perfect time to invest. Just start and keep going. Step 6. Stay consistent. Investing is a marathon, not a sprint. Don't panic when markets dip, and don't chase hype when things are booming. Stick to your plan and review it once or twice a year. Remember, the best investors are patient and disciplined. Review your progress, adjust if needed, and keep learning. You've got this. One of the biggest mistakes beginners make is chasing hot stocks or following tips from social media and friends. For example, buying a stock just because it's trending in the news can lead to big losses when the hype fades. Instead, focus on companies with strong fundamentals and a track record of steady growth. Remember, if it sounds too good to be true, it probably is. Another common mistake is not diversifying, putting all your money into one stock or just crypto. Imagine investing everything in a single company only to see it crash. That's a recipe for disaster. Diversifying across different assets, like stocks, bonds, and funds, helps protect your money if one investment goes south. Trying to time the market, guessing when to buy low and sell high, almost never works. Even professional investors get it wrong. Instead, invest regularly over time. This strategy, called dollar cost averaging, helps smooth out the ups and downs. Ignoring fees is another costly mistake. Even a 1% annual fee can eat away tens of thousands of dollars from your returns over decades. Always check the expense ratios and fees before investing. Low-cost index funds are usually a smart choice for beginners. Finally, emotional investing, letting fear or greed drive your decisions, can destroy your portfolio. Selling in a panic during a downturn or buying in a frenzy during a rally often leads to regret. The best investors stick to their plan, stay calm, and focus on the long term, no matter what the headlines say. Let's talk about long-term strategies that actually work. The first is dollar cost averaging. This means investing a fixed amount of money at regular intervals, no matter what the market is doing. For example, you might invest $200 every month, whether the market is up or down. Over time, this reduces the risk of buying at the wrong moment and helps smooth out the ups and downs. Next is the buy and hold strategy. This means you invest in quality assets and simply let them grow for years, ignoring short-term market swings. Historically, the longer you stay invested, the higher your chances of making a profit. For example, the S&P 500 has returned about 10% per year on average over the last century, despite many ups and downs. Asset allocation is about spreading your money across different types of investments, like stocks, bonds, and real estate, based on your age, goals, and risk tolerance. For example, a younger investor might have 80% in stocks and 20% in bonds, while someone nearing retirement might shift to 40% stocks and 60% bonds for more stability. Finally, rebalancing means checking your portfolio once a year and adjusting it back to your target allocation. This keeps your risk level where you want it. For instance, if stocks have grown and now make up too much of your portfolio, you sell some and buy more bonds to get back to your original plan. By following these strategies, investing regularly, holding for the long term, diversifying, and rebalancing, you give yourself the best chance to build wealth steadily and confidently. So here's the truth. Investing doesn't need to be complicated. Start small, stay consistent, and let time and compounding do the heavy lifting. In the next videos, we'll dive deeper into specific topics like index funds, the psychology of money, and how the stock market actually works. So make sure you subscribe and keep building your financial future.